Hey, Dr. Terry,
Yes.
will you do me a favor and try to share your slide presentation? Okay. Yeah, that looks good.
Yeah, I was trying to figure out a way not to have the stuff on the left, and let me try. See what happens if I do this.
Okay. Yeah, you're looking good. All right. Thank you.
Okay.
Hey, Dr. Terry, will you say something for me, please?
Yes. Can you hear me? Can you hear me okay, Grant?
Yes, we're good.
Is it where it needs to be right now?
No, it needs to be down.
Okay.
Members of the State Board of Finance, guests, and members of the press. I see a quorum, both here in the room, along with those who are on Zoom. And so I call the meeting of the State Board of Finance to order. What I'd like to first say is, with regard to the those on Zoom who are on the board, if you have a question and you want to be recognized, what I'd like for you to do is to go on the chat feature of the Zoom and make a note that that's what you would like to do, and we'll see that we have someone monitoring the chat. And I personally don't know where it is, but I understand it is on there, and so you would be then recognized to ask any questions or make any comments that you may have. I appreciate it. And as we go through the meeting, when you have something that you'd like to visit about, let us know, and we'll recognize you. Additionally, we're going to go through, this is the actual quarterly meeting of the State Board of Finance. We have our normal business. We're going to conduct that at the beginning. That'll be the first order of business, is go through the normal things that we do. When we conclude those, what I'd like to do is take about a 5-minute break, and then we will, when we reconvene, we will then get into the employee benefit board issues that we've been discussing, and we started last Friday. And we have a consultant from Atlanta, the Milliman Group, are here to provide a significant amount of information having to do with the EBD and the financial aspects of the plan that we have before us. What we have today, and can make estimates of anything that we want to possibly make any adjustments to. So I'm looking forward to that discussion when we get to that part of the meeting. Does anybody have any questions? Okay, seeing none, I guess the first item of business would be to the adoption of the February the 9th minutes, February 9th, 2021 minutes. They've been distributed via email, so if I would have a motion to adopt those meetings, I would appreciate it.
Mr. Chair, excuse me, I have a correction.
Okay.
On the minutes. The second paragraph, Cynthia Bearden from the Arkansas Natural Resource Commission, she is now the CFO of the Arkansas Securities Department.
Okay.
Correct that.
We'll do that. Thank you.
I was in surgery, sorry I was not here last.
Okay. And now may I have a motion to accept those minutes as corrected?
Motion.
Thank you. All in favor, say aye. Aye. Okay, the next order of business is I'd like to recognize Dr. Andy Terry and Dr. Ashman Bebacher, consultants that we hired about 1.5 years, 2 years ago to give us their current report with regard to the financial policy for the State Board of Finance. Are y'all on?
Good morning. So is my screen showing?
Yes, it is.
Okay, so good morning, everybody. Thanks for having us. I understand you have a packed agenda, so even though it looks like there are a lot of slides, I think we can get through them really quickly. If not, Dr. Bebacher will turn off my computer. So as Mr. Walter said, this is a follow-up from our report from a little over 1 year ago. And this report is focusing primarily on cash flow analysis, target asset allocation, and then ultimately how to measure performance. The previous report, we had a lot of recommendations. The Treasury has already implemented many of those, if not most of them, and is in the process of doing the others. And this report is focusing on the areas where they ask for more specific help. Ultimately, what we're trying to do here is install just a little bit more structure into the investment process. So we reported to the board in December of 20, and we actually already talked about the details of what we did to analyze cash flows. We really got into looking at daily cash flows for 7 years, and this was a massive data. But ultimately, what we were trying to figure out is what's the maximum liquidity need of the Treasury, because the investment policy statement, the priorities are safety, liquidity, and return in that order. And so, as I said, we went through a lot of number crunching. We also validated the existing Treasury model, which is a good model, and hopefully added more data that they can use. But ultimately, what we decided is that $650 million relative to the current size of the Treasury, or 14%, recognizing that the balance is going to change as the budget changes, will meet their liquidity needs. And so that's our sort of bottom line conclusion with respect to liquidity. This is just a chart. I'm going to skip this. I don't think it helps much, but this just shows, again, looking at the last 7 years, that from a warrant standpoint or a cash outflow standpoint, the largest single daily outflow was around 470 million. And then on a net cash flow standpoint, around 440 million. And so we're adding a buffer, which is intended to include bank deposits, which the Treasury holds. So that's the liquidity analysis part. Again, bottom line, they need to hold 14% of their portfolio in liquid assets. So the asset allocation piece, the objective here is ultimately to figure out how much of the portfolio can we invest longer term, because the only way to realize a higher rate of return on a fixed income portfolio, at least with a traditionally upward sloping yield curve, is to either invest longer term or to take on more credit risk. Well, we're not advocating necessarily taking on more credit risk, and the investment policy statement currently really addresses that issue already. So what we're looking at is, okay, how much can you invest long term? And so the second piece of our analysis is trying to figure out what part of the Treasury's balances are permanent or persistent. And so if there are any bankers out there, the analogy would be, what are core deposits, that I can rely on as sort of always being there, understanding that there are literally hundreds of accounts that are going up and down, but from a portfolio standpoint, there's always a minimum amount that's there, or a predictable amount. It would be a better way to say that, that's there. We also then looked at big accounts, the ones that could skew the deposits. And so the classic examples would be the highway department, because they have, the really big funds, and then education. And then finally, the short-term bucket. So we recommended 3 buckets. The short-term bucket is simply the difference between our liquidity bucket and our longer-term bucket. So this is just the picture. Liquidity, as I said, we determined needs to be 14%. Now we're focusing on what can the long term be. The buffer or shorter term bucket then would be what's left. So I'm going to cut to the chase. Our recommendation for the longer term bucket is a target of 65% and a range of 55 to 70. So letting it go up 5% on the higher end, but down 10% on the lower end. Liquidity we just discussed. So we view that as a minimum, but it could obviously be higher. And then short term is the buffer, which turns out to be 21 as a target. And then the buffer, can go down 10 or up 5, at least based on our recommendation. If anybody has any questions, I'm happy to entertain them. I mean, feel free to interrupt me in between, but I'm going to keep moving otherwise. Yes.
A quick question. The ranges, are they the actual results that you observed that the Treasury.
So that's a perfect question segue into the next slide. So the next three slides focus on the longer term part of the buckets, if you will. And so this looks very busy. So just forget all the details and look at the very light blue at the top. The light blue at the top represents the proportion of the portfolio that's been invested in the longer term bucket. And the thing to take away from this, other than it's a very busy picture, is that it's very volatile. Okay, it bounces around. And so a different way to see that is on this bar chart, the blue bars represent the maximum that was invested. So the very top is the longer term part of the portfolio. The gray bar is the minimum and the gold bar is the average. And so you can see that the portfolio has ranged from 38% on the low end to almost 81% on the high end, with a mean of 55%. So sort of pulling this together, comparing what we're recommending with the question you just asked, what is the history? Here's the answer to your question. So historically, the portfolio has had an average of 55% invested in it, but that average has fluctuated from 38% on the low end to 81% on the high end. Our recommendation is 65% target for the long end or longer term bucket in the portfolio, but that you keep that range tighter between 55 and 70. Okay, so we're recommending a higher allocation to the long-term bucket, but also the tighter range. And so this would be our sort of core recommendation, if you will, with respect to the longer term bucket. Great question. All right, so the last piece.
Yes, I have a question.
Yes.
So we have to accept the fact that if we limit risk, we limit reward also, correct?
That is correct, yes. And so, you know, again, what we're trying to do is say, all right, subject to our liquidity constraints and the amount of risk that we're willing to take, you know, our last remaining choice is how much can we safely invest longer term? And so that's where our focus was in trying to figure out, well, how much of Treasury's balances are core deposit like or are persistent. And then from that standpoint, then we can invest those longer term. Now I say longer term, it's not like I'm recommending, you know, equities or 30-year securities. That's not what we're saying. We're saying, relatively speaking, relative to the liquid bucket and the shorter term bucket, what can we put out there in a range, you know, that's in the 5 to 10 year range versus less, you know, much less than a year or 1 to 3 years. Anybody else have a question? All right, so the last piece of what we were asked to look at is how do we assess performance? And so in order to assess performance, we need to first have a target asset allocation. So that was, you know, you have to put that in place before you can measure performance. The second step then is what's a fair benchmark against which to measure performance? And by fair, what we really mean is that it, you know, something that has reasonably the same investment objectives and investment assets in the index or the investable alternative. And so we actually have provided the Treasury two lists or two benchmarks. One is a pure index. And so I think everybody's familiar with like the S&P 500 or, you know, Barclays has different fixed income index. Bloomberg has lots of indexes. Bank of America Merrill Lynch provides literally hundreds of fixed income indices against which you can measure performance. Those are nice, but the problem is that they're not really what we would call investable. And so what we prefer is an alternative investment that if Treasury didn't actively manage their portfolio, that they could say, okay, I'm just going to invest in this. And so a simple example would be on the short end, rather than buying commercial paper and other short-term liquid assets, you could put the money in a federal money market fund. So that's a simple example. And there are other index funds that basically have the same objectives that the short-term bucket and the long-term bucket has. And so we're looking for something that's a viable alternative to actively managing the portfolio. And these indexes also, when we say fair, what we mean is that the Treasury management, the investment team, has to feel like, they're trying to do the same thing we're trying to do, because otherwise it's an apples and oranges comparison. Going along with the apples and oranges comparison, so one of the significant changes that will come about to this approach, or as a result of this approach, is that Treasuries will have to measure total return by bucket. And this affects the State Board of Finance as well, because y'all are used to being reported to, the reporting to you historically has been on a yield basis. Our portfolio is yielding whatever. So what's the difference? Well, the difference is unrealized gains and losses. So again, historically, the returns that have been reported are actual yields, interest or income yields, and realized gains or losses. Okay, so the difference is unrealized gains and losses. What difference does that make? Who cares? Well, what's going to happen is it's going to make returns more volatile. It's going to make the reported returns more volatile. So why are we recommending this? Because the indexes and the investable alternatives all are reporting returns on a total return basis. And so we can't just compare part of our return with the total return somewhere else. We've got to compare apples to apples. And so looking at total return from our viewpoint says, you can't really get too hung up on short-term fluctuations. You really need to take a longer-term focus. It's not that you don't report things quarterly. We're not suggesting you don't report on a quarterly basis, but we are suggesting that you don't get too hung up on, well, the return in this quarter, was really low because interest rates increased and the value of our portfolio declined. That's going to happen. And the reverse could be true as well. Interest rates could fall, the value of the portfolio would increase, and those aren't realized returns. And so the Treasury can report enough information, hopefully, to break it down and say, look, of the total return, here's how much of it is represented by an unrealized gain or loss, and that might help assuage some of the concerns about the volatility of the portfolio. All right, so once we've measured total return by bucket, we compare it to the benchmark. And then the last piece of this is trying to analyze why we're different. The fancy name is called attrition, or not attrition, attribution, portfolio measurement attribution, or performance attribution. What do we attribute the difference to? And really, it's going to be two things. One is that we have a target asset allocation, and we've chosen to deviate from that for whatever reason, or we've selected securities that are slightly different than or what on average are represented in the benchmark. And so from our viewpoint, this performance measurement process, this is going to be completely new. And it's exactly that. It's a process. We're not going to get it right the first time, but we feel like that we need to start and then tweak it as we go along. And we also, want to make clear that we don't view this, the purpose of this isn't to be punitive in any way to the investment team. It's rather to help explain to the State Board of Finance why the investment teams, or why the portfolio performed the way it did, particularly in comparison to some other alternative portfolio or alternative investment strategy. And, hopefully, like I said, hopefully the State Board of Finance we'll look at, I mean, our purpose here is to provide information, more information to, you know, so that I can understand why did we perform the way that we did. Yes, somebody had a question? No?
I don't see any questions at this point.
Okay. So as I said, we had two different types of benchmarks. One is a pure index, and I'm not gonna, these are too busy to get into the details. I'm assuming that y'all have these packages and you can go through them, but these are the pure indexes, which are not necessarily investable per se. And then the next table, these are what we would call investable benchmarks. So these are literally, these are assets that Treasury could theoretically actually invest in. These are index funds or ETFs, which are equivalent to index funds. So the last thing we were asked to do was look at the investment policy statement and, you know, see if we had any recommendations. And we actually, in our prior report, had already made, I think, several recommendations relevant to or relative to the investment policy statement. And I think Treasury has either implemented those or attempted to implement some of those. So the investment policy statement, you know, so the high level principles from our viewpoint come from, you know, I think come down from, I guess, the legislature and governor, those at the very top of the governing process. And those are the guiding principles for the investment policy statement. The policy statement itself, though, from our view, you know, needs to be flexible and adaptable for a couple of reasons. One is because budgeting environments change, the economy changes, but also capital market conditions and capital market investment opportunities change. And so we've got to be able to, you know, not every month change the investment policy statement, where that's not our point at all, but it's also not, it shouldn't be rigid. You know, we would say maybe annually review the investment policy statement and make sure that it doesn't need to be tweaked here or there. So the State Board of Finance is, you know, is really the fiduciary for the Treasury, and from our viewpoint, they're the ones that, you know, that should have sole authority and sort of take ownership of the IPS. We do recommend that the IPS be revised to include a target asset allocation and, you know, a requirement to report total returns and explain deviations. And so the details of these don't need to be in the IPS. That's not the purpose. You know, policy doesn't, from our view, doesn't include the specifics. It just includes, hey, you're going to report, or you're going to have a target asset allocation, you're going to report performance, and you're going to explain deviations from a reasonable benchmark. All right, so in conclusion, as we said, the Treasury has really done a lot from where we started, I guess, almost 3 years ago now. This is kind of the last, trying to put the last pieces of the puzzle together. The target asset allocation, and then performance measurement and benchmarks. As we said, we think the State Board of Finance is the logical body to own the IPS. And then finally, you know, we appreciate the people at the Treasury who have been really helpful. They've given us everything we've asked for. They've been completely transparent. It's been a long process, but a good process, and hopefully we've added value somewhere along the way. So I'll open it to questions, which I'll let Dr. Viehbacher answer.
Thank you, Dr. Terry. Does anyone have any questions or want any kind of clarification on any of the things that come up on this report? I guess I'd like to ask a question of the treasurer. Y'all have been working with Dr. Terry and Dr. Viehbacher. This is a report that they're making. It would seem to me that we need to accept the report as presented, but we will take some time to look at the report and determine how we will implement that report in the actual day-to-day business of the week. Next, State Board of Finance, we would ask for a recommendation from the Treasurer's Office about how we would implement it. Does that seem to be the right way we ought to approach this? Because this is the first time I've seen it, and I'm, I obviously, Alex, I feel comfortable accepting the report, but the next step is that we need to internalize it within this board as well as the Treasurer to determine to what extent we accept their or agree with their recommendation and move on.
Secretary, I agree. I think a lot of what they done, I read about a lot of diet programs, but you need to put them into play in order for those to work. So yes, I agree with you totally that these individuals have been excellent. I really think they provide a lot of direction to us.
Okay, I appreciate that. I've tried those diet programs too. Okay, so are there any questions or clarifications of any of the board members? If not, then I would ask for a motion to accept the report as presented.
So moved.
Second. Any additional discussion? Seeing none, then all those in favor say aye. Any opposed? Okay, thank you. Okay, the next item is the presentation of the Treasury Investment Performance Report by Treasurer Milligan. Treasurer Milligan, you are recognized to present your report.
Well, good morning and thank you, Mr. Secretary, and good morning, board members. A lot that we need to cover today, so I'll try to keep my remarks brief. In March, we hit the 1-year anniversary of the first COVID diagnosis in Arkansas, as well as a year navigating through an economy impacted globally by the pandemic. While we continue to see historic activity in the stock market, the fixed income market is not experiencing the same rebound. So please recall the relationship between the stock market and the bond market is one resembling a seesaw, meaning that when one is up, the other one is lower. And as you know, we're still feeling the impacts of COVID on the bond market. In reviewing the 10-year U.S. Treasury over the past 12 months, which is the most relatable rate for the sectors we are invested in, you will notice rates started around 160 basis points in February of 2020, then hit a low of around 53 basis points in July. Currently, you will see rates are back averaging around the 160 basis points where we began at a year ago. So in some respects, 2020 has turned into the lost year for bond investing. Again, we're starting to see some rebounding in the sector compared to the quicker 9-month turnaround of the stock market. I also like to point out that we're starting to see expectations of rising inflation, and we are monitoring its impact on the bond market specifically, in addition to the economy as a whole. Maturity shorter than 1 year, yields are still close to zero at this time. As such, our short-term portfolio earned $808,000 for the quarter, which we expect this situation to remain until the Fed raises rates, which they aren't discussing until 2023. As the Fed rates near zero for the short term, we moved some funds further out in duration to pick up slight yields where we were able. As a result, our long-term portfolio earned $8.2 million for the quarter. Like many of our operations and cash flows were tested through the pandemic, yet we persisted. That experience, combined with the analysis by the consultants, has given us an even better grasp on our liabilities and income. The bottom line is that we know we're operating within the necessary cash flows of the state and that we have appropriate guards for safety. Speaking of allocation, our portfolio for the end of the third quarter is shown on this slide. It paints a very different picture than what you saw a few years ago. This is part of our continued effort to diversify given the constraints of the investment policy the market and its natural ebb and flow as it continues to work its way out of the pandemic. Total revenue for the quarter ending is $9.05 million, which is similar to the fourth quarter of FY 2020. I point this out because those are very similar points in time. Initial response of our economy shutting down due to COVID, and now the start of its reopening as we move into the next phase. We continue to see slight improvements each quarter despite the challenges of navigating the portfolio. During the pandemic, we maintain an operational liquidity throughout while staying secure in a conservative investment structure. I'd like to take a moment to turn to the reports from the consultants we just heard from. Thank you for your hard work and dedication. I'm very proud of the working relationship and positive changes my team has adopted thanks to the recommendations of Drs. Terry and Beebacher. If you allow me, I'd like to walk through their recommendations quickly. There are many items similar to their last report that we've already started incorporating, and there are others that are going to take a longer time to implement. For instance, we're already in line with their recommendation on portfolio allocation or developing a total return and benchmark model that we will collaborate with the FNA on to bring back for your consideration in August. We also agree with the recommendation to achieve more corporate exposure in the portfolio and have taken early steps to determine the most appropriate way to do so. This leads up to their final recommendation, the need to address our investment policy statement, review current language in the law that governs the state's investments. I've asked my staff to identify a third party to assist in reviewing our investment policy statement and governing laws. They will then bring to the board a list of recommendations for your review consideration. Looking to the future, I'd like to let you know we're close to selecting a new senior investment manager to work alongside Robert and the team. I hope to be introducing this person to you at our next regular board meeting. Finally, again, I want to thank the consultants for their diligent work. I look forward to implementing the things we've discussed today. I want to take a moment to share a little praise for our investment team. Robert, Damon, Celeste have done a tremendous job navigating our portfolio throughout this past year and have built a great foundation for us as we move forward. I'll also take just a moment to brag on the entire office and how they remain steadfast in their work in the uncertainty of COVID. Their dedication allowed us to remain open, operational, without missing a beat. They've implemented new technologies for state agencies, continue to find and innovate ways to improve the cash management functions of our office, as well as all of the state agencies we serve. With that, Mr. Secretary, I'd be glad to answer any questions.
Thank you, Mr. Treasurer. Any questions for the Treasurer of the State of Arkansas?
Mr. Secretary, no question, but a comment. I would just like to commend and acknowledge for everyone that the report that we heard earlier, as well as the Treasurer's comments, are very consistent with what we expect banks to maintain from a liquidity management standpoint and from an investment policy standpoint. Their entire liquidity and funds management program is consistent with some of the comments we heard today. So I applaud them for being industry norms and looking forward to seeing what that looks like for the State Treasurer's Office for Arkansas.
Thank you for that confirmation. Okay, I'd like to have a motion to accept the Treasurer's report, please. Any additional questions? Excuse me, a second. Do we need a second? A motion and a second. All those in favor say aye. Aye. Any opposed? Good. Okay, the next item are the quarterly motions for the first quarter of 2022. That's July the 1st, 2021, and through September the 30th of 2021. These motions were included in the documents that were distributed to you by email. As chairman of the State Board of Finance, I make a motion to the board that no funds are available for deposit into the State Board of Finance Certificate of Deposit Program. May I have a second, please?
Second.
Any questions? All those in favor say aye. Any opposed? As chairman of the State Board of Finance, I make a motion to the board to direct the treasurer of the state to purchase warrants for the succeeding quarter. That is July the 1st, 2021 through September the 30th, 2021, pursuant to Act 1088 of 2013, and to keep reasonable amounts in demand deposit accounts and money markets during the next quarter for the transaction of day-to-day business. May I have a second, please? Second. Please, let me have a second. All those in favor say aye. Thank you.
I have a question about that one. I always, I see the word reasonable and I immediately go, huh, is there a definition of reasonable in state law? Moving right on.
Is that sort of a rhetorical question?
The next item is consideration of the treasurer of the state employees' minimum qualifications, and I recognize Grant Wallace to present this report.
Thank you, Mr. Chairman. So in accordance with Act 1088, the State Board of Finance is required to set the minimum qualifications for the investment positions within our office. With our FY 2022 budget, there were some title changes, so I just walked through those real quickly. Rather than the Director of Investments, that was changed to a Senior Investment Manager, again, making sure that those are two co-equals in overseeing the investment portfolio for the office. We have a new title for Investment Manager 1, a new Investment Manager 2 title, and then we have added a director position. We changed the title of it, but it is now the Director of Investment Accounting. And this individual will be solely responsible for the accounting operations of the investment functions of the office. We have kind of segregated that out. Historically, it was done within the investment office, and now we pulled that out in accordance with previous recommendations from the consultants. So this just implements that. We do have that position filled. They are in office, but this is just creating a title. So with that, I'd be glad to answer any questions.
Anyone have any questions? If not, I would accept a motion to accept these minimum qualifications described by Mr. Wallace. Second.
Second.
Thank you. Any additional discussion on this motion? All those in favor say aye. Any opposed? Thank you. Thank you, Grant. Okay, we're at the point right now that I mentioned we would take about a 5-minute break and then reconvene here at, let's say, 11:45. We're in recess. Finance meeting today. I'd like to call back to order, and the next order of business is the State of Arkansas Employee Benefit Division Plan. For this item, I'd like to recognize the Secretary of the Department of Transformation and Shared Services, Amy Fetcher.
Thank you, Secretary Walther. I just wanted to introduce our consultants that are here from Milliman out of Atlanta, Georgia. The actuarial firm that has had this contract since the fall of 2019. We have Mr. Courtney White and Mr. Paul, help me with your last name. Thank you. That will take the presentation from here. What we had suggested is that maybe we will spend 30 to 45 minutes on the ASE, the state employees, and then the same amount of time on the PSE, public school employees, just to make sure we get through it all. They're not going to go through every slide in the information you have, but we did want to provide it. This is a compilation of about 6 months of reports that they've put together in one document for you all. And we're welcome to you asking questions as we go, if that's okay, Chair.
That's correct.
Thank you. So Courtney and Paul, I'll let you take it.
Thank you. Thank you for having us. Look forward to going through this process with you. We know it's new to everybody, so we'll certainly open to questions. We'll help you explain it. If you hear terms that you don't understand, certainly ask, because we use these terms every day, and we're used to the meeting, but they may not be clear to everybody else. Okay, the first thing I'm just going to start out by saying is that these are actuarial projections. So that means these are looking at the future. A lot of you probably have finance and accounting backgrounds, and you're looking at everything that's in the rearview mirror. We look out to the future. We're trying to estimate, guess what's going to happen for calendar 22. So our projections are based on some form of historical information. And the key thing about that is, the further we are away from where our historical information is and to where we're going, the more volatile projections are, just like the investment projections. So the closer we can get to those timelines, the more accurate they can be, but there's still going to be volatility. So we've taken a lot of the data from the EBD vendors. We look at that data, we develop assumptions, we talk to EBD, we talk to the vendors to try to get as much information about that gap between when we know what's going on to what we don't know what's going on, and try to fill in those holes as best we can. But just keep in mind, these are going to change. They change every month as we get new data, we refresh it. So just to give you kind of a high level view of how we do things. So we look back in time. So for example, we're looking back at data that's because of the pandemic, we're actually looking at pre-pandemic medical claims because they were significantly affected by the deferred care and things like that. Pharmacy claims, we're looking at the most recent data. What we do then is we look at that data and we try to project from that time point into 2022 based on anything we can develop assumptions about: medical trend, utilization increases, changes in benefits, changes in demographics, changes in any kind of underlying initiatives within EBD, to try to get as much information we can to predict that future number. And then we do that for claims and administrative expenses. And then we say, that's how much money we need to run 2022. And then we look and say, okay, well, what do we have at our disposal? So we have state funding, employee contributions, and EBD income. And what are the knowns around those? So that's what we then use to figure out how we're going to help recommend or advise on changes. So this agenda, go to page 2. So here's the agenda. This is, as Secretary Fetcher said, this is a lot of information, considerations, decisions from the last few months from the EBD board. So we're kind of help point this together. We'll try to hit the highlights as we go through them. So I know she presented a lot of those on Friday. On slide 4, this is what we refer to as our budget levers. These are really the 5 things that we can do to get to a balanced budget. The first one is state and school board funding. So right now, the state contributes money on a per budgeted head count basis. For 2021, that number is 420. On the school district side, they have minimum school district contributions that they provide, and that varies. And they can provide above that level. So those are the kind of the state funding options. The second choice is employee and retiree contributions. So that's, that's the amounts that you have taken out of your paycheck for payroll deductions. That's the amount that the employees pay in or the retirees pay in to help cover their benefits. The third one is plan design. So that's things like changing your deductible, changing your co-pays, changing your maximum out-of-pocket max, things that can affect how much you pay out of pocket when you receive care from a physician, hospital, or a pharmacy. The fourth one is the EBD initiatives. This is things like pharmacy programs to help reduce costs that are more behind the scenes, or we're helping doing some benchmarking to look at some of the medical costs and see if there's any outliers when we benchmark it as to where we might be able to put programs in place to help curb costs. It really is more behind the scenes. The members and the employees may see that because they may be asked to join this program to help reduce their costs. But for the most part, those are things that are done after the fact. And the last one is the reserve. So the way the plan has been set up historically is there's been a catastrophic reserve set up on the balance sheet to use to help fund years where claims are higher than projected, or there's a lot of high cost claims in a particular year. So that's it. And we try to not touch that because that puts you in a situation when you don't have enough money to fund, multiple years of losses. So that's kind of where we are right now. That reserve has been used over the last 2 or 3 years to help keep premium increases down, no benefit changes, and using the reserve as the primary function to fund the plan.
Are you going to get into recommendations with regard to reserves, what best practices are?
We do, yeah.
Thank you.
Okay, on slide 6 now, this is just a high level summary from for ASC. So there at the top, you can see we're using data for medical claims between March 19 and February 2020. So basically, we're trending that data to 22, assuming that claims and utilization are going to return to pre-COVID levels. We don't know, right? I mean, it's still too early to tell. Hopefully, they're not significantly higher. They could be lower. We just don't know how care is going to change between now and 22. But for pharmacy claims, we're using the most recent data we have through January of 21. So that's more accurate. It wasn't really affected at all by the COVID. The claims continue to move forward.
Excuse me, Kara, I have a quick question. I can appreciate taking out the 2020 pandemic effect, but do we have any harm by taking that out because we had perhaps such increase due to illness? Is that significant enough to factor in and try to analyze that in some way, or is it too hard to analyze or not significant enough?
It was nowhere near the level of deferred care. Yeah.
Thank you.
There's a graph in the back. There's a trend graph that shows it. When you look at, think of a trend line goes flat, but like that. March and April went like this, and then came up and went like that. So there was a significant drop that more than offset the cost of COVID testing and treatment.
I have a question. Did they provide you loss ratios on the year basis where we were at last year? And the loss ratios in the year before?
Yeah, we'll get to that in a minute, right? So the highlights here are in 2021, so we're still projecting 21 as the data evolves. We're projecting, right now we have actual data through in this presentation through March. So we're projecting the last 9 months of the year. The deficit is around $6 million, and that's after any kind of surplus allocation. So the prior board took surpluses from the current year and allocated them into funding for future years. So say there was a $10 million surplus in 19, they said, let's take 50% of it, put it in 20, 30% in 21, and 2% or 20% in 22 to spread that money to help kind of ease things out. The tough thing about that is those are all projected numbers too, right? So if you miss the current year, your $10 million or $5 million, you don't have that money to help fund those reserves. So that's what the before and after surplus means in these bullet points. So we're showing a $6 million projected loss for 21. As we move down to the bottom, 22 is a status quo scenario in this, and we'll get to the changes in a minute, but basically assuming no changes in contributions, no changes in state funding, no changes in benefits, just exactly the same thing as 21.
This is state employees.
Employees. Right. And so for 22, prior to any changes, we're projecting a loss of just over 27 million.
That is business as usual.
business session. Right, so, the next slide, slide 7 shows a more traditional income statement. So you have your income at the top and you have your expenses at the bottom. So we don't really look at loss ratios from that perspective. We're looking at, you know, claims, actual expenses, and actual gains and losses. So from a, you know, we could calculate the loss ratio, but we're not trying to hit a target loss ratio from a pricing perspective. And for those that don't know, a loss ratio is your incurred claims in any time period divided by the premium. So it's an estimate of what % of your premium dollars were used toward claims. So we're actually calculating, it kind of gives you an estimate of the gains and losses on that. I'm going to jump to slide 8, which what we use to do is try to tie the income statement and the balance sheet together so you can kind of see how they interplay. So the green bars are revenue in millions. The yellow bars are expenses in millions. So that's claims and admin. And then the gray bar is our net assets. So that's our available assets from a funding standpoint. It's almost like I think about it as your bank account. So your income statement, you're writing checks, you're bringing income in. You got money sitting off to the side in your bank account to help fund for rainy days, buy a car, pay for your house, whatever you need to do. So the key statistic here to look at is the box in the middle, the blue box with the percentages in them. That's how much available assets you have as a percentage of expenses. You can see back in 2019, we had 73.2 million in net assets that were 24% of your expenses. The 24% is about 3 months, right? So that's 90 days of reserve. So typically, plans would hold somewhere between, let's say 45 to 90 days of reserve. Right now, back in 19, you're holding almost 90 days. And then you can see what happens with that number as we go through 2020, 21, and into 22 is that reserve as a percentage of expenses is going down. So 2 things are happening. Your expenses are going up because of medical inflation, changes in headcount. Your reserve is going down because it's being used to help offset the losses in those years because the funding wasn't adequate to cover expenses.
And you consider the reserve being the assets net of IBNR.
Correct. Because those are free assets, available assets. So what we have is, by 2021, we're projecting at the end of the year, you're going to be at 10.7. So just under 35 days or something like that, but then actually down to 2%, so about a week by the time you get to 2022. And so just for reference, on ASC, pay a roughly $1 million a day in claims.
And the 2022 projection is if we can do anything.
Correct. And then the next 2 slides show similar things, whether it's graphically and they're notoriously to kind of track the numbers through. So let's move on to slide 11.
I'm hearing terms and I'd like to make sure I understand them completely. You've mentioned the catastrophic fund and the reserve fund. I mean, my understanding is you have like 3 funds here. Can you break them out for me and tell me what you have in each of them?
Yeah, so think of it.
What we have.
Think about it in your bank account. You have your assets, and those are funding a catastrophic reserve. And then there's reserves that are set aside for future premiums. And then you have your free assets. Those are the three sets of monies that are being funded on the balance sheet.
Okay, clear as mud. I'm sure.
So I want to ask a question. So let's back up about 4 years. So let's say that we had a good year. Okay? And we had that extra 5 or 10 million. Which pot would we have? You put it in 2 different pots.
The board could decide.
Exactly. But I'm just saying in that situation, you said we put some in 19, some in 20, and 21. Did you put it in allocated or catastrophic?
It would have depended on where the catastrophic reserve would have been. If it was fully funded and it hadn't been touched, then it would go into premium allocations for future years. So it's like a pre-funding of expenses for future years, so you don't have to increase the employees' premiums or change their benefits.
So really, it's one pot, but it's two, saying if we had a really bad year, rather than just draining on allocated surplus, we would use some catastrophic, because it's a really bad year, we take something in the pot.
Right, because, yeah, I mean, the premium amount was a board decision, say, this is 15 million in this year, so that you wouldn't take any more from the future years from there, but you could draw down a catastrophic reserve to help offset those higher expenses. Okay, so this shows a historical view.
I'm a little confused because I thought, well, let me ask you another way. Let's go back to 2020. 52.5 million actually is all three of those accounts that you referred to. Is that correct?
That's right.
Right. I did not know that we had segregated it into three different parts. We had that, but we used it in order to deal with catastrophic issues, premium possibly, or whatever. My understanding, am I wrong?
They're on the balance sheet. There are clearly three buckets. You know, this is catastrophic reserve. This is amount for future premiums, and then the net assets. It's all assets on the balance sheet, but there's three different accounts.
And if I went to the accounts of EBD, I would find three different dollar amounts that would add up at the end of 20, we're in 21. If we're correcting our assessment, it would add up to $35.6 million. All three.
I don't know how it's handled accounting wise, but on the balance sheet, those are clearly called out on the balance sheet.
Thank you.
It's all in one account at BBD.
Yes, I'm sorry. Yes, Mr. Chair. Okay, so with all three accounts, the first two, and please correct me if I'm not understanding this, but the first two, what I would consider day-to-day operational funds and monies. The third one, your true catastrophic account, really should never be touched unless you have an extreme emergency or an extreme need. The first two, day-to-day funding, operational, you hope your catastrophic sits on the side and does exactly what it's supposed to do, is active.
Remember, every month they're bringing in premiums, right? Payroll deductions and premiums from the retirees. So that is first used to cover your expenses. And then if they're short, they might have to do a draw for the balance sheet and then to help fund things get through. So that would come out of your net assets, your available assets. Yeah, we don't usually want to touch the catastrophic. And usually the board decisions, we want to, you can see that, what year was that? Oh, in 18 to 19, they did reduce the catastrophic reserve from like 30 million to 16 million. It's not on this chart, but you can go back on it. And then the allocated assets based on prior year surplus, those wouldn't be used in the current year either. Those would be something that would be used for next year.
And is this money put in these accounts on an annual basis, or is money moving out, in and out during the year, like if they have a bad month, are they losing money?
Yes. Go to slide 11, please. This is just a historical view of the financial statement, really the income statement. So I'll just draw your attention to the middle there, surplus deficit. Started in 2018, you can see things started taking a turn for the worse. We started losing, the funding wasn't enough to cover the expenses. So the reserves were being drawn down upon to help do that. Some of that was probably intentional because they were trying to limit rate increases. They probably thought we weren't there at the time, but we had excess surplus. So let's try to lessen the impact on the employees as we go forward. So that's just a historical view of the funding and the expenses. And you can kind of see, you can also see if you look at the total income, excluding the reserve, the income has been fairly flat, starting between 15 to 20. It hasn't changed very much. it can go up and down due to headcounts, it can go up and down due to the budget headcounts, but it's not changing very much, but your expenses are continuing to go up 5, 6, 7, 8% per year. So that's the big takeaway here is that you can't, in health insurance, and you all see it because you deal with, family members who have private insurance. Your insurance goes up every year. There's medical trend, there's increase in headcount. You can't just try to fix it once every 5 years. You got to have some kind of policy in place to keep pace with it. Always the private sector will say, we're going to put in we're going to budget for a 5% increase in healthcare, and then they manage to that. And that means they either have to cut benefits, they got to increase contributions, or find some other way to cover the shortfall. That's just.
Well, on that point, have we quantified what the inflation is per person in cost? Do we know that number?
We do everything on a per capita basis because that boils it down to the
So what is
simplest
that?
form.
What is that percentage?
It's hard to tell because of COVID, right? But prior to COVID, ASC medical costs were running around 5%. PSE were higher in the 7-8% range. Pharmacy costs have been around 8% per year.
Per person?
Over the past 5 years, do you feel like that they've been moving the program with the fall trend or not?
It is not, no. And then exhibit 12 is similar. It shows a chart that shows how the funding has changed. So if you look at the middle chart, the left box is the state funding, the middle box is the employee funding. Other income is things like pharmacy reserves. We get a subsidy from the federal government for prescription drug coverage. And then, that's other income. Other reserves is the money that's set aside to fund future years, and then also any gains and losses in a year. So you can see that the state funding has gone down as a percent of total cost. Employee has stayed a little bit flat, a little bit down. Other income has been really flat, but really the change has been the dipping into the reserves and using that money to help balance things out. Right. Okay, so let's jump to exhibit 15 or slide 15. So this is the last board meeting we have, the EBD board. So this is a summary of the decisions and recommendations that they made for ASC. So way to look at this is we're starting with a $33.3 million deficit projected for 2022. Each one of these items has a price tag to it. We modeled to show what the expected savings was. So the first one is a 5% increase across the board to the active employee contributions. That saves $3.1 million. One thing I'll point out that's a little tricky is so you all have a wellness program today, right? You can go to a health fair, get a health check, smoking cessation, and you get a $50 reduction. You get a $50 credit to your employee contribution. That program cost about $3 million. And so there's a lot of discussion around the value in everybody getting those health checks, right? Does a 27-year-old male employee need to get all that done to him? He's probably healthy. But on the flip side, everybody has stories about, I found skin cancer, I found cancer during my check. So there's a balancing act between having some sense of wellness program in place, and at the same time, how you fund it. So you're paying out money to have the health check and giving all those people $600 a year to do that. So it's a kind of a double expense from the state side. So one thing we're recommending is to eliminate the screening. So you don't have to go to Catapult or your doctor to get the screening. You can go online, do an HRA, follow up that way, and then really changing the way that funding works. So what we would do is increase all the active employees contributions $25. So instead of having a $50 credit, you'd have a $25 credit. But then for the people who don't qualify, they get a $50 penalty. And it's going to be a lot easier to qualify now.
I just want to add, the plan would still cover an annual visit if somebody wanted to go get an annual visit. It just would not be required to receive the wellness credit.
Correct.
Can I just ask a question? Is there any hard data proving those wellness checks work?
Yeah, there's been studies by, some of the medical journals, but we can provide those too. We sent those to Secretary Petcher that showed that
Our data in Arkansas that they were,
they are not, they're more nationwide,
okay,
that they don't work.
correct. That's what I was wondering. Okay, thank you.
I mean, there's value in them and they're creating an overall healthiness of the community, but there's very low ROI on how much you're spending to
That's what I
on the
was
return.
wondering.
Correct.
Okay, thank you.
I'm glad you clarified that was not what I concluded in the first.
But the other big lever here is the state funding increase. So the $50 increase to $500 per budgeted headcount per month. So that's $20 million. So if all these things were approved like they were by the EBD board, that would take us from a $33 million deficit to a $6.2 million projected surplus in 2022. It also provides for a 10% reserve on the balance sheet. So that's about $35 million for ASC. So we would cover all our expenses in 2022 and have a $35 million reserve set aside in case things are worse than expected, or if it's not, then that can carry on to 23 and be used for future years.
Well, I got a question. You're building a pot, and we were talking about a 5% trend, $50 per month, and that's close to $10 million. Isn't it close cost on about $450 per employee? That's the state contribution.
That's the state funded. That's the employee. Yeah, the funding.
I'm talking about when you put, what I'm saying, when you put it all together, you know what I'm saying? It would cost about $450
$450 million or
$150 per employee per month.
yeah, $450 per employee per month. But remember,
So if half of that, half that income is the state, that's 10%. 10% is 20. I guess what I'm trying to say is, it sounds like we're doing the same thing. We go along for 2 or 3 years, and then we overflow, and then we get extra money in this pot that's allocated reserves. We don't make any payments, and in 3 years from now, we're back at the same point. What's the problem with that?
well, so our recommendation is that you would continue to increase. So we're kind of doing one big catch up here, right? To get to level set the field, say, all right, we need a plan for 23 and beyond, and we're working with Jake and EBD to help come up with that. The goal would be that there would be some principles in place for this board to say, you know, we want to have X% reserves. We're going to have minimum employee increases each year, and then other levers to guide you through setting policy going forward, so that, you know, if trend next year is 4 and we say we're going to put in a minimum 3, then you just need to come up with 1 for somewhere else.
So this is more, getting you catching up today.
Yes.
We've got time for the.
Yeah, that chart showed 5 years of not doing much, and this is like, we got to level set. We got to get things straight because we're in bad shape if we don't do something.
So we're funding more on this one than you expect.
You're still got medical trend is still, you know, say 6% a year, so that's, you know, $25 million a year. So, and I think, you know, the state funding hasn't always been available. I think Secretary Petcher can correct me about how that works, but, you know, it hasn't, if we look back over time with this chart, see, it hadn't increased from, you know, it went from 410 in 2014, and it went to 420, and it stayed at 420. So from 14 to 19, to 20, it only increased $10 over that time. So inflate, like to your point, inflation over that time would have been 5 or 6% per year. And that was getting, you know, 2%.
I'll just add, you are correct. There's never been anything where it was evaluated every year. And the board made that decision. The EBD board, Director Blade and myself would really like, as Millman is suggesting, to have something, an automatic percentage on the state and the employee side each year, looking at the cost from the previous year.
The cheese is moving.
Sure. Real quick, sir, I'm sorry, Keith, to your point, so it's gonna get us level set back to where we are, or perhaps maybe at least where we are today. But if you said all these savings would get us to a 10% reserve, that is literally what's shown on slide 8 for 2021, but we really want to get back to more of the 24% range for reserve, correct?
Yeah, and those are all 22 numbers. Yeah, so that is that.
But I mean, what I'm saying on the 21 slide, you're showing a 10% reserve for the 21 year in the light blue box in the middle,
Yeah, given how far we were from,
right?
we said, let's use 10% this year, and the board can decide if that wants to be a bigger number going.
I was gonna say that 10% doesn't even really get us where we need to be, right? Correct? Okay.
So we could recommend to get that higher.
Perhaps over time or all at one time.
Or one time.
Yes, sir. Okay.
Yeah, so along those lines, I'm not gonna go through these, but I would draw your attention to slide 16, 17, 18, 19. Those are the 2021 employee contributions, retiree contributions, and the projected 22 if all of those board recommendations are accepted. So slide 16 through 19. So I would just say, look at those. That shows the impact to the employee on a monthly basis if these changes were accepted. So some of those are fairly significant. So if you were to try to build more on the reserve, those would also go up. Right.
And the max the state can do statutorily is 550.
Now I want to jump to slide 20 just real quick before we look at the actual modeling. So this is just a list of all the things that we considered this year. A couple things that the board decided not to do was the increase the deductible by $250. Slide 20. Yeah, so they did the first four. The fifth one down is the $250 deductible. So the feedback that the board got from their constituents was they would rather pay more out of pocket in premiums than have their deductibles or co-pays increased when they go get their service from a budgeting standpoint, I guess. So that we did not make a change to the deductible or the out-of-pocket max. The second thing was Health Advantage had brought something to EBD. The way that post-65 retirees coordinate with Medicare is generous. They basically don't pay anything because it's secondary to Medicare. And the proposal was to make those Medicare costs subject to similar plan designs as the active employees. We can talk about that later. That's a complicated issue, so I don't want to get into it here. If that's something that someone wants to talk about later, and we can talk about it at a future meeting. It's just it's a way the order of the benefits are handled when you're a Medicare retiree.
When you're a Medicare eligible active employee, how are they? Are they required to go to Medicare as an active employee?
They're not if they're active. They don't.
Medicare secondary.
When you're active. When you're primary Medicare, if you're a Medicare retiree, Medicare pays first, and usually a Medicare retiree would pay Medicare copay, or usually it's like 20%. So if you had $1,000 service, Medicare would pay $800, the employee would pay $200. EBD picks up that $200 today. The proposal was that $200 would be subject to another deductible and co-insurance, like the active employees.
And is that for medical and
Only medical.
So basically what we're doing, if I understood you correctly, the summary of the initiatives, the first four were the ones recommended by the previous board.
And the state funding increase.
So we've got a bucket, and all we're really talking about is how to adjust what's going into the bucket, not the spigot at the bottom of the bucket.
That's the way the board went.
Okay, thank you.
And we looked at a couple other things. So discontinuing Medicare eligible spouse coverage for over 65. So currently Medicare eligible retirees and spouses get prescription drug coverage. As you probably all know, the board voted to eliminate that coverage for 21 and then reverse that decision last year. So this would be just eliminating spouse coverage. And the thinking behind that was today that if you're an active employee and your spouse has coverage elsewhere, they don't get coverage through the state. that right, Shalana? That was the thing that, and so that would reduce both expenses and funding. You'd lose their costs, but you'd also lose their contributions. So it's, we should probably move to the interactive module so you can kind of see how this all fits together. But we have an Excel model that will let you kind of see how the interplay of some of these things work. And it shows both the funding and the impact to the employee and the retirement. It's on your iPads.
There is not. There is not, Secretary Walter, it's the interactive spreadsheet, and so it's there, not a slide.
Thank you very much.
Essentially what we did was we created a model for the EBD board that allows them to turn off and on at different initiatives as well as changing employee contributions. And so in the model, you can play around with the changes and see what the impact would be to the bottom line. So the model that we currently have plugged in, or the assumptions that we have plugged in, was based on the latest EBD board recommendation. So you'll see that we turned on the contribution increases for the active pre-65 and post-65 with a 5% increase, a 10% increase for the pre-65 and a 10% increase for the post-65. Similarly, some of the other initiatives that we've looked at and talked about was around the wellness program. So the wellness reduction was a $25 increase to the employees who currently get the wellness credit. So that was a $25 increase, which shows the impact of 5.2 million. The non-wellness increase, those are for the employees who do not currently get the credit. If we impose a $50 surcharge, that would be about that 3.5 million. And then we talked about the wellness program and the requirements around this wellness screening and the biometrics. If we eliminate that requirement, we would see about that $2.7 million savings on the wellness program. So what we've done is essentially allowed the EBD board to play around with a couple different scenarios to see what the impacts were to the employees, as well as what it means for the bottom line budget.
This may not be something the board wants to get into today, but after you know all of the things for both plans that we could do, we didn't know if the board would want to make any recommendations on things to tweak over the EBD recommendations.
Does anyone have any changes that they would like analyzed on this interactive?
So you're assuming, I'm sorry, Jim.
Go ahead.
You're assuming that everybody who doesn't get a screening now, because they have to go do something, is automatically going to absorb the $50 penalty or increase when they could just go on a computer and check the box.
So we have a couple slides around what changes we would suggest or look at for the wellness program and how wellness programs work in general. What this is assuming is that employees who currently do a preventive screening today, a lot of them may not, who are young and healthy, may not necessarily have to do that requirement anymore, but there may be additional requirements that we can talk about to implement around what they would have to do to earn that incentive. So from a wellness program, design, we usually think of it as 3 phases. So the first phase of a wellness program is really understanding your numbers. And so over the past about 5+ years now, the program has been to incentivize employees to go get their wellness screening and their biometrics. And the plan has been paying for that screening as well as incentivizing it through the program. So the thought was to go sort of to the next phase of the wellness program, which is really, now that you know your numbers, is sort of to educate yourself around your condition. So if you know that you have high blood pressure or high cholesterol, the second step of the wellness program is now to educate yourself. So we've been looking at ways with EPD, what is available in terms of how can employees and members educate themselves about their different conditions. So typically that's around like health coaching or lifestyle or online e-modules and stuff like that. So instead of doing a wellness screening to get your credit, it might be that you might want to do like completing online modules to educate yourself on how to improve your conditions in order to earn that credit.
So to understand this again, you said at the beginning of the year, y'all automatically put the money in the pot, and then if they don't do the wellness, it reduces it. Is that correct? How's it funded? How's it funded?
They qualify by a certain date in the end of the current, so like they had to have their wellness completed by a certain date in 2020 to qualify for 21's wellness credit.
Yes.
That's the,
They have to have it completed right now in October. During open enrollment, has to be completed by then. So you'll get the credit the next year.
And they'll get the $25 credit or $50 increase.
but we did test scenarios around the sensitivity of, you know, if 50% of the people who are non-wellness today move to wellness or 100% move to them. So this has to be kind of independently modeled because they're all unique and we don't know what the interplay is based on what people are going to choose. But we looked at some of those things to make sure that, you know, we're not overstating any kind of savings when we actually go to put it into the.
And large companies like this, really, there's a lot of them that they fund the HRAs on an annual basis. Is that any conversation regarding that?
There's HSA contribution today for ASC employees. I think it's 25 for single a month and 50 for a family. PSC, it varies by school district, I believe. But we also looked at, I think there was a proposed law to kind of blow that up into a much bigger amounts, and it was going to cost a significant amount of money.
I have another clarification, please, and this is real basic, but it'll help me understand. Let's just say a monthly premium to the employee is $100. If I am electing to go get my wellness visit next year and I receive a $25 credit, then my portion I'll pay every month is $75. If my colleague who chooses not to go get their wellness visit for any reason, then they're going to pay $150.
Plus the 5%.
Okay. Thank you.
On the starting one.
Okay, thank you.
I know we haven't talked anything about admin fees or plan. As far as the percentage of the total cost, is it compared to others? Concern I had is I saw one of your slides at last Friday's meeting. It showed the cost to be approximately $46.95. When I calculated it here, it's about $27. So I don't know what's going into admin, what's going into plan. I know what does it cost to run Cobra, the HSA program, you know, wellness, and what are the costs, all of the fees. Those are solid numbers.
Yeah, we can provide more detail around that. Some of those numbers could be PEPMs versus per employee per month versus per member, which is a belly button. So, you know, if there's 2 people per family, some of those numbers could be double depending on how you're measuring it. It's the same aggregate number, but it's how you measure it. But the TBA went out to bid effective 1/1/19. So that's the last time those fees were looked at in terms of competitiveness relative to the market. So there's different fees. There's the health advantage fees that they pay on a per member per month basis. There's med impact fees that are paid monthly for the PBM who manages the pharmacy program. And then there's a third bucket of just general plan administration. It's, you know, it's our services. There's other kind of consultants in there. There's probably some of the, I don't know all the details of what the fees are in there, but we can provide more detail around it.
Does the state participate or give any contribution towards any other members other than the employees?
I'll add that on the state employees, the state contributes per member per month for every budgeted position. So that would be the field, and some of them are unfilled. If it's a budgeted position, then they're contributing for each one of those.
Maybe misunderstood. The spouse and children, do y'all contribute towards? spouse and children.
We spread it all around. We spread the state contribution to all the tiers of
An employee with a family does not, they pay, they pay more than than a single employee, but it's not like the exact
So I guess my question, if it costs $400 to cover your spouse, does the employee have to pay $400 or do they pay $300?
if they less.
Does the state put any money in for this spouse?
Or children?
For children?
The state doesn't, but it's funded through the program.
Right.
The 450 goes in per budget person. So if there's 35 budgeted employees, there could be less covered employees on the plan. But that aggregate, not money comes in, and then that money gets used to fund all different kinds of family sizes and retirees.
Is it in this number?
Yes,
The number you're giving me is not the employee cost. It's the whole.
yes.
And you heard what was said, that the state puts in money regardless of whether there's a body in that position. If it was a budgeted position,
Yeah, I do.
I just want.
So if we have 99,000 or 93,000 people and there's only 90,000 people, the state's funded more than $50 per member per month or per person per month.
Yes,
Actually, boy.
budgeted positions. So actual employees plus budgeted positions that are unfilled. And part of why we do it per member per month is to catch the federal dollar, because a lot of employees are paid through different sources, through federal or special income or cashing revenues. And so to catch the federal money, we have to match it per member per month. I don't know what the rationalization was to do the unfilled budgeted positions, but if we take all of those away, the cost will significantly go up for those active members.
Yeah, if I can add, I think of the per member per month rate on the state side as really means to spread the cost across the different colors of money that we have in state government, federal dollars, and then the different types of state funding. But that one budgeted position won't necessarily correlate to number of belly buttons, as the consultants would say. You might have we might pay on a per member per month basis for a budgeted position that's empty. We might pay per member per month for a budget position that has one employee with 17 kids. It's really a mechanism for us to provide funding to the plan. Now, when the funds arrive at the plan, those funds are spread out in a way so that we can subsidize on the family or the spouse or the individual membership plan. So we do subsidize family plans. We do provide support for employees who bring their spouses and children on. But on a funding side, we do not. That makes sense.
So, and I'm sorry, we're using the wrong verbiage, per member per month, it's actually per employee per month. So I guess what I'm thinking is we calculate a cost of claims against everything we're doing budget wise, the cost of claims against the income coming in. If you have 1,000 people that don't exist, you have zero expense, and you have 100% income. So when you're running the budget, it's really kind of a false budget because there's nobody there. You can never have more people than you have positions, but you can always have less people than you have positions. And I do understand the federal side of it, but it's confusing. Were they aware of how many how many empty people there were?
It doesn't really matter to us, right? Because we know how much money's coming in, because we know what the budget is, and we know what our total expense is. So think of it this way, the way that it's calculated, the way that it's funded from the state side is to take advantage of whatever tax advantages, federal matching funds it is. At the end of the day, you still need $185 million. So it could be $450 per budgeted head count, or it could be $900 per active employee. It's just a way to move the money around in a way that maximizes whatever goals you're trying to achieve.
So if I can add to that, by purposes of comparison, on the public school side, they do it by funding per employee who's actually enrolled in the plan. So what they'll do is at the beginning of the year, they'll get a report that will lay out the number of people who have actually enrolled. There might be public school employees who are budgeted, but they don't enroll, so therefore the districts don't provide funding for that individual. They do it differently.
And their number is like $161, $164 per enrolled member per month, per enrolled employee per month.
To ensure we have time to get through the public school employees, do we want to move on to that one since it's been about 45 minutes?
Mr. Chairman, this is good information. I think we need to have as much time as we need to study all this.
Are there any more questions on the state employees right now? It is important that we do hear from Melvin with regard to the state, the public school employee.
The only reason we say to break it up is because we've done this the last 6 months with the EBD board, and we end up, spending an hour and 45 minutes on state employees and 15 minutes on the school employees, and the school employees actually have a bigger issue than the state
All
employees.
right, let's, one more question from Andre Lee.
Pharmacy plan, I just want to make sure I understood that. That was a recommendation made 2 years ago by the board. Legislature came back and said, no, don't do it. If I'm not, I'm giving a cursory summary.
It was last year.
Was it, it
It
was
was
2020?
a 20 for this year's plan.
Okay, I'm a year off. I guess we all lost a year there. For some reason I was thinking 2019, okay. Well, and if I'm not mistaken, it was to move retirees, eligible retirees to Medicare Part D.
Medicare eligible retirees and their spouses.
Thank you. What was the savings on that?
Around 38 million.
I just, we brushed up that real quick.
And it would always change depending how many was on the plan, but at that time, it was around 38 million.
And when was that decision made?
We made it in August of 2020, which was later than normal, as I was saying last week, due to the pandemic and not being in person. It was made later. There was a huge outcry from the legislature and retirees. They asked us to look at it again, and then the board rescinded that vote in September.
Okay,
September.
thank you very much. Thank you, Mr.
I
Chairman.
will note that the school employees don't have medical pharmacy coverage.
Right.
I noticed that.
Could we have that, when we look at the summary of initiatives that were modeled, could that be one of them that added to that list?
Basically, just pick it up where we left off, right?
We'll update it based on the most recent information. Yeah.
Because
Are there any other items like, pardon me, like that should be added to the list?
There's another one around Medicare eligible retirees. So the private sector insurance companies can offer an employer group Medicare Advantage product. It can cover medical coverage or medical and pharmacy. And the state can benefit from the federal subsidies the insurance companies can receive from that. We looked at that on pharmacy based on a proposal from MedImpact, but it might be something that could be too aggressive for 22, but it could be something we look at for 23.
Is it voluntary by the employee?
It would be mandatory and cover everybody.
I don't understand the nature of it, but it might be something. we want to do.
You're talking about retirees, or are you talking about active?
Medicare eligible retirees.
Retirees.
Okay, thank you. Are we ready to move on to the public school employee portion? Okay, thank you.
Similar is that we also modeled what the impact is for the public school employees. So from a high level summary, in 2021, there were a couple of decisions made So one was an increased funding from the Department of Education of $20 million. So late last summer, the Department of Education increased their funding by about 20 million. Additionally, for the 2021 plan year, there's a one-time funding source of another $20 million to help with the funding for the 2021 plan year. Based on those two increases in the funding for 2021, the deficit before any prior year allocation from that surplus is about 12.7 million. Based on prior year surplus, so in 2018, 19, et cetera, some money was set aside to help funding in 2021. Similarly, as the ASC, we talked about the different buckets for the assets. There was about 15.5 million set aside for the PSE plan in 2021. And after that, there's a deficit or a projected surplus of about 2.8 million. For 2022, once again, sort of a baseline scenario as we project going into 2022 based on normal medical trends that we have seen in the past, normal pharmacy trends, changes in headcounts, no changes in program designs or anything like that at this point. We're projecting about a $70 million deficit when we look at the amount of funding coming in versus the amount of expenses going out. And then 2022 is the last year where there has been surplus or assets set aside to help with the funding of about 7.1 million. So we're seeing that deficit of about 63 million. So once again, going to really slide 24, this sort of puts together the income.
With regard to 22 and the 63, is there still a reserve associated with that of 10%? Is that?
So we'll get that onto that on the next slide of what that might look like. Okay. So on slide 24, once again, so the green bar represents the revenues for the current year. So in 2019, we see the revenue of about 326 million. The yellow bar is the expenses, so about 339 million. And then the gray bars are the assets or the net available assets. So back in 2019, there was about 116 million of assets. And if we look at the middle blue bar or that middle blue box, that was about 34%. So our assets represented about 34% of our expenses. And that is about 4 months of assets available to us. As we went into 2020, that dropped down to about 25%, which is about 3 months. And going into 2021, if projections hold, we'll be down to about 18%, which would be about 2 months. And so looking now at really 2022, we see that the projected revenue is about $380 million, where our projected expenses are about $450 million. So that's that $70 million deficit from an income versus an expense side of things that we're trying to solve for. So like we said, that's sort of that catch up in 2022. What that would do is, so that gray bar in 2022 is at 3.8 million. If we were able to close that gap of that 70 million, that would go up by $70 million. So we would be left with about $74 million worth of assets at the end of 2022, which would be roughly about 2 months.
Back to where we were projecting for a year in 21, just like on the state employee side.
But the revenue in 2021, does that include the green right there, includes the 20 million in special funding?
It does, yep. And so if we go back a slide on 23, you'll notice that, so there's a couple different funding sources for the public school employees. So the PPE funding is the per participating employee, and that's the amount that the school district provides. So as we talked about earlier, the funding is based on those employees that are actually enrolled in the benefit, where the minimum district or the district will set aside $165 to fund it. The other funding source is the employee or the retiree contributions. And then we have the Department of Education. And then we talked about some of the other revenue, which is like the pharmacy rebates or FICA savings. So in 2022, you'll see that the Department of Education funding went from, I guess in 2020, it went from 90 million to the 130. So that's at $40 million of extra funding from the Department of Education, including the 20 million of the one-time funding. And then in 2022, that one-time funding goes away and we're back down to 110.
Questions, John?
Please.
So the school district is supposed to pay 165 per employee. Are they doing that? I mean, we're comfortable they're doing that, okay? Participating employee. I know, it's, you guys deal in real minute descriptions of things, got it. So the PPE funding, that's per employee funding, per participating employee funding, okay? It's not 165, why is it not 165?
Oh, these are in, the top table are in millions. And we're getting,
Please excuse me, of course they are. Okay, so the schools are paying 165 per employee. Okay,
We do have the CFO from the Department of Education, Mr. Greg Rogers, here too, to answer any specific questions on school funding formula or what districts are paying.
thanks. And the one time, it wasn't 30 million for some reason, I was thinking they were talking about 30 million, so they dropped it to 20 in actual funds that they gave. Okay. Did you want to say something? Thank you. You didn't want to say anything, I respect that.
So the first of all, on the first one, the school districts, the minimum that school districts have to pay is the 164.44 until December of 21, then it goes up to 168 and change. That's the minimum that the districts have to pay on that. They can pay more, a lot of districts do. I don't have a list, but I think there's like 150, 160 there, right at the minimum. Some districts do pay more per participant for the insurance program. The $20 million, that was what we had discussed back when we were looking at that. The last actuarials showing how much the insurance program was projected to be short. And so we went and got supplemental appropriation to make that payment this year to kind of help level out that, which I think is going to get to $12 million. It's currently showing projected payment.
So did you guys pull that out of your catastrophic fund?
Yeah, well, yes, we had, since the defunding was released, we were able to budget additional funds for insurance this year.
Excuse me, did the legislature choose the 164.44, or the school district itself? Who chose that number?
So the 164 is based on in code. It was set at 150 back in the special session that was done to deal with teacher insurance. What was that? 2014, when they did that. So they set the $150 at the minimum contribution that per participant that the school district has to pay. That amount increases by the amount of the foundation funding increase that the adequacy committee recommends, which is the per pupil funding amount that each school gets for students in Arkansas. So as that this year, they increased it by 2.33%. So the minimum contribution for teachers insurance has to increase by that 2.3%, unless in code in 6, 17, 11, 17, there are exceptions to when a district doesn't have to contribute to increase it. And that is if they're increasing it already based off having to go to a minimum salary scale that the teachers are required to be, or they have 75% of their participants already in the insurance program, or they're already contributing 125% above the minimum amount required.
So you're saying the legislature sets that price, and as we're looking here, each year, so you're saying the last time y'all moved. So I guess my point is we're back into the same situation. Who on their funding side of it, who's following trend? Who's standing up and saying, we've got a medical trend of 5%, but we're only gonna raise what we're putting in the pot $3? Or, I mean, and is this gonna be another situation where we're gonna throw a bunch of money in and then get us up to speed and then move forward? Is that what we're working on this one for the schools out there?
I don't think so. James probably throw something in it, but I think that we've gone through this, so we've got a lot of different moving parts. So you have the adequacy committee that's meeting that sets the per pupil funding amount.
And that, where there's a matrix that's involved in it, and they come out to the $7,182 per pupil that's set. There's a matrix, in that matrix, there's an insurance part in there. But the current law says that the only increase that districts have to do, if they're at the minimum, is that 2.33%. So I think what discussions that I've had with Jake and going forward is that is something that the Department of Education and EBD recognizes that we need to study and we need to stay on the same page and take recommendations to the adequacy committee to make sure that the increase for the benefits is keeping pace with the cost of inflation of the insurance program.
Within that matrix, there's an amount for insurance is what I just think I heard.
There's an amount for teacher salary and benefits.
And is that one number or is that two numbers?
It's one number. It's, well, there's teacher salary in there and then the benefits is another number right there. But in that benefits, the calculation for insurance is in there.
Is the 166 close to that number?
I'd have to go back and look. I didn't look at the matrix working, sorry.
Could we, I think that'd be an interesting thing to see.
I can get that for you.
I do, Chairman, I do. Andrew, you talk about those three pots instead of one pot. So in a perfect world, if everything was running, everything was running on our projection, and we ran at 5%, we know medical claims are uncontrolled. But we also know there's years that we have minimum claims. So we end up with $30 million. And we're funding 5%. But we have the $30 million. In the corporate world, you put that in that reserve that you have. And then when you have that year that you have a 10% increase, use allocated reserves to keep you at the 5, correct? We're having to fund.
Yeah, in a perfect world, all your funding sources would keep pace with trend. If they don't, then you gotta find other levers to offset that shortfall.
So, I'm sorry. Go ahead. So, I know the adequacy group meets. Were they presented with a lot of this from the EBD group during the adequacy discussion? Was it, I mean, going to your question of, did they address it? I mean, moving $4 doesn't seem like a lot. So I'm just wondering if how much it was addressed in the adequacy discussion last year.
So in the adequacy committee, I'd have to go back. I don't remember specific talking about insurance, because as you know, they look at all the different things that go into funding the student, whether it's transportation, teacher salaries, everything that goes into it. So I don't call specifically for insurance. I have to go back and look at all the different things that went on.
Thank you.
So just doing a time check. So let's jump to slide 31. So slide 31 represents what the decisions were from, or the recommendations were from the EBD board for the PSE population. And so what they were looking at was about a 10% increase to the active employees, which would be about 11.4 million in additional funding, 15% to the pre-65 retirees, and 20% to the post-65 retirees. On top of that, similar as ASE, they would look to reduce the wellness credit for the active population from the $50 a day to $25 per month. And then for those on the non-wellness employees on the active side, they would also see a $50 increase in their contributions if they don't meet their wellness requirements. Then also changing the wellness requirement program to eliminate the preventive screening. When we look at all of those initiatives, that produces about $40 million of additional revenue or a reduction in expense. So earlier we were talking about that we're trying to solve a $70 million gap in 2022. So this gets us about 4/7 of the way there, so a little more than half. So this is where we last ended off with the EBD board of where we were for CY 2022.
Well, we haven't mentioned anything, and I certainly know that cost estimated into benefit program for the different types of benefits, deductible, co-insurance, out-of-pocket, things like that. I think it's only fair that when you're talking about funding something at a 5% trend, that the benefit package should do the same. It's my understanding they've been between $500 and $1,000 up for about 10 or 12 years. I know in the corporate world that has moved along with all the other pieces of the package.
We did look, sorry. We did look at those things, and it's in some of the, I don't remember what page it was, but on the factors that were considered, we got a lot of feedback on deductibles, and that, I think that's why the board chose to go in the direction of not changing benefits or deductibles, out-of-pocket maximums, and raising the contribution.
Starting on slide 54, we actually benchmarked the EBD plans against 7 surrounding states or 6 surrounding states. So the funding and the benefit plans are at a high level. The details are in the appendix about each plan. EBD offers 3 plans. For ASE, there's the premium plan, which I think is a $1,000 deductible, $500 deductible, and then they have 2 high deductible plans, the basic and the classic. PSE has, and like 85% of the people on the state employees are in the richest plan. They're not choosing the high deductible plan, so they're willing to pay the more out of pocket than take the consumerism side and take a high deductible plan. On the PSE side, it's split. Like, I don't know, 10 or 15% of people are in the richest plan. 55–60% I think are in the middle plan, and then the rest of the people are in the high deductible plan, and that's mainly driven by their contributions and more limited salaries.
I did notice, and you showed it Friday, and I don't want to go through all the appendix, but for example, I think it was Oklahoma, had a $500 deductible plan, they had about a $1,500 deductible plan, and they just said, the difference between Arkansas and Oklahoma, when we use it as a comparison, it was $6,175 out of pocket. It didn't matter which plan you chose. On our Cadillac plan, you're out $2,000, and then you're on the HSA, you're $6,600. So I guess what I'm trying to say is, I know in the real world, everybody's hung up on deductible, but there's a lot of other moving parts in there. And I'm not ready to go down the road. I just want to be over there.
Last question, then there's a lot to digest, and I'm sure we'll meet again soon to dig into more detail. Just so you know, this is the same process we went through at the EBD board. I mean, it takes like 2 or 3 meetings to actually understand and feel like you can follow what we're talking to.
I'm gonna put the worksheet up there on the PSE side.
Can I ask a question? I did not see, did the previous board have a policy? Are there policies for how they made decisions? Is there something that?
There are no guiding principles. That's one thing we're trying to help, and we talked about earlier is, you know, what are your guiding principles? So when people come on and off the board, they kind of know, all right, you know, what are my options? You know, here's my 5 buckets I need to think about. How we can do things like that. I think that's
There
one
were
thing.
when you were brought on board, when you were hired, there were no guiding principles or policies. Well, I'm using the word policy here.
I think the new director has ideas about how.
There were not, and we did get into guiding principles this year, and also Milliman has provided educational units for all the board members, and we to just kind of get them up to speed before there was no orientation of such that I'm aware of for board members.
We're going to give you all access to that same educational information. There's 7 videos that you can download and watch in your free time.
Okay, when we were talking about the state employees, you had the levers, the things that we had some control over. Would you go back over what they are with regard to the public school?
Sure, they're similar. So that's slide next slide, or, so it applies to both. So
Okay.
for funding, the school board has an extra one because they have the DOE funding and the school districts, where this ASC only has the state.
And with regard to the recommendations, and I forgot what chart that was on, with where you had also overlaid the recommended changes to the plan. Could you take me back to that slide?
For PSC,
Yes.
38, I think. 31.
Let me get there a second. And what I see is there are recommendation to make $40 million in changes, but it still leaves a balance with 29.7.
And the thought process was that the board was, well, they were going to do as much as they could do that they felt comfortable approving. And Secretary Petrick could talk to this, and then they would go talk to the state about what they thought initially needed to be done, to show that there was a collective effort to help cover this deficit. The board would take some responsibility for what they were going to do, and then the state would also have some responsibility.
On the PSC side, there's no mechanism for the board to have input on what the state, the Department of Education, or the school districts are giving. That's all defined in school funding formula. So while we can make recommendations on the state side, we cannot on the public school.
Yeah, Greg's still here. You have an amount that you do normally build into your budget to provide for EBD for the state teachers. Continue to public school.
Yes, well, we have two lines in the public school appropriation act that are dedicated for public school employee insurance. One is called public school employee insurance, and one which is $57 million. And we have another one that was just increased to $20 million, which is additional public school insurance, for make a total of that one 35. So, and then we have two old bond debt programs that have been ongoing, that the General Assembly diverted the extra of those funds to go to EBD as well. So it's around now with the increase 35, it's around 110 million that we put in each year for
ongoing. And last, in 2021, the year we're in today, you put in an additional, how much?
Yeah, we went to, that's what we were discussing earlier, that we went to the General Assembly and asked for a supplemental appropriation for that additional 20 million for FY 21.
And that made a huge difference in the plan and in the viability plan. But you still took money out of the reserve, is that correct?
I don't believe they have yet.
No, we didn't take money out.
Okay.
21.
So one of the, I'm trying to figure out what the options are today. First question I have, are there other things that we could do in addition to the ones we've done to make a difference? And then I guess that would look at it, and to the extent that there aren't any, or they don't get to $29.7 million, then we will be presenting that to the legislature, to the ALC, so in order to complete 2022, we're going to need $29.7 million, and that keeps a 10% reserve. Is that kind of what we're looking at as we move forward?
Correct.
Okay.
Unless the board decides to tweak any of these initiatives, that number could change. But I believe we are looking at going to the legislature and recommending an amount for the state to contribute.
There's additional alternatives we looked at on 36, similar to ASC, like the benefit plan 9, the retiree one, eliminating some of the benefit plan. But I think the board, I put words in their mouth, but if you look at the premium increases that are following the board recommendation, they're pretty significant. So they think they got to the point where we've shifted a lot of the cost to the employees and not comfortable doing much more.
It would seem to me we need to assess that. We may very well come to that same conclusion, but I think we need to revisit those.
I would encourage everyone to dig into the information on the benchmarking for states around us, where we're putting $450 in a year. Now currently in Alabama, they're putting over $900 per member per month in. And that's the kind of the two extremes, but we are very low on state contributions with surrounding states, and we are very high on employee contributions.
When was the last time, I'm trying to remember what year, the last time the legislature put a dropped money in the EBD, a chunk?
13,
Was it 13?
and I don't recall how much it was.
Yeah, does anyone remember how much that was?
Jake, do you know?
I've heard up to thirties, but I don't know specifically how much. That's mainly legislative state. We can
Now, I have one quick question. I happened to flip through and I noticed on page 29, it states that they expanded the $75 wellness credit requirement to houses. That's a lot of money. Is that still in place?
Until this year, we were giving a $75 credit, and the board did vote for, in January of this year, it went down to $50.
They don't get a $75 credit.
Oh, I thought they reduced it to 25. House gets more than the.
No,
The 75 credit, so an employee could get up to $75 per month. The spouse doesn't get that too. They get the visit though, right? They get the visit, but not the additional funding. They both have to qualify.
So if they both qualify, the employee gets 25 and the spouse gets 50.
They both get 70. They get 75. It's one contract. So it's, if their rate is $400 or $800. But they both have to qualify. So it was a benefit to give the spouse that coverage for that wellness visit for free. But they both have to do it to get $75.
So we've got calculating here, the reduction from 50 to 25 is $11.7 million. Does that reflect what y'all did on the stock?
Yeah. It would
We're
work.
making them 11.5 million.
So it would work the same way. Instead of having a $75 credit, they'd have a $25 credit. And they would both have to apply. Qualify. So it was 75 in 2020. The board moved it to 50 in 21, and the current proposals moved to 25 in 22, but at the same time increase the people who don't qualify up another 50 to get this a different $75 gap.
So most of my employee spouse can get it $60.
total,
Or the
one $50, not one for each.
family unit can get $50.
It's true.
Yes.
So if I'm correct on slide 31, back when we were talking about ASC, the list of initiatives were, let's say there were 7, and you said they selected 4 of the 7. Has the previous board, did they consider all 6 of these as their final, or are there only a handful of these 6 on 31 that they were looking to accept?
Those are final.
The recommendation was all of them.
Okay.
It covered 4/7 of the law.
Okay.
Were there any recommendations y'all had that didn't make the sheet?
We looked at the other alternatives are on 36 that we looked at, similar to ASC. So the retiree coordination of benefit, deductible and co-insurance.
I'll just clarify, Milliman figures out the calculations for us. They don't really make recommendations to the board on what they should select and which direction they should go.
They didn't pick any of these?
Or did-
No, I mean, y'all didn't bring these to the board?
We help them think through where their levers are and what would different values be, what they ultimately take.
So, which means that if we have some ideas that we would like to be determined economic impact, we can do that and they would provide that information.
Right, so they show up with 15 ideas, even though they didn't bring the ideas, they show 15 ideas and y'all pick 6 of them.
Well, and some of the initiatives were put on there at the request of board members, yes.
You gotta
Well,
choose with something.
we might steer them down the path of, hey,
Here's what they did somewhere else.
here's a 10%, here's what a 10, some are, there's only a limited number of things we can put on there. So, but, looking at the retiree contribution, things like that, or not the, retiree benefit designs, some of those things.
So what you're saying is page 36 is back on the table.
Right, I mean, that's our job. Making determinations to make a recommendation to the legislature, to the AOC. Very helpful, gentlemen. I think, speak for myself, probably most everybody else, this has been quite helpful to us. I think there'll be more that we will ask you to do, as we move forward. So, I'd like to talk about the next step for the board. We're in this together, and I would like to seek your input on how we, what the next step is and when we do it. Specifically, we've been meeting on Friday, now we met today. I would entertain, the idea of meeting for the next several Tuesdays. It's also part of the deal, when we became members of the State Board of Finance, that these are unusual circumstances, and we have an additional responsibility if there is an urgency to. And I'm not saying it has to be done in 3 weeks or 5 weeks or 10 weeks, but we do all understand that there, on January the 1st, employees need a healthcare plan. We would recommend it. So the sooner we get our job done and make that recommendation to the state legislature, the better off we're going to be and the better off the employees are going to be. We've got a lot to weigh, as we have seen. This went through a process for 6 or 10 months, and a lot of work's been done, so we don't have to do everything over. But we do have, we do still need to evaluate what's in front of us, whether we agree with it or not, and we won't make it up. And so I think that's going to require us to continue to meet on, and I would suggest for now that we do it on a weekly basis. I apologize if it inconvenience to y'all. We can do a lot of it by Zoom. I prefer, and it's worked very well. Most of us are here today, and I think that's worked extremely well. We've had a lot of feedback. Your input has been, I'd say, invaluable to me. And I know there will be a lot more questions that we'll have for you, and I don't know if we want you here each time or maybe every other time or something like that. And we may put some requests out there for you to participate on a regular basis to help us get through it. Does anybody have any comments? I've kind of laid out what I'm thinking. I'd like to have comments from this board because we all have one vote, and I think we need to come to an agreement on how we want to approach this. So I'd entertain anybody's comments.
Mr. Chairman, I did follow up after Friday's meeting with some leadership at the House and Senate, and they will be meeting in July. It wasn't on the calendar, but their commitment, they said, because of CARES Act and what was happening with the change in this board, they were committing to AOC meeting monthly throughout the year. So just wanted to fill in on that.
And the other consideration Secretary Fetcher has mentioned is the idea of getting the plan in the hands of the employees and the retirees so that they have adequate time to evaluate it. And we need to keep that in mind, but it can't be if we have to take an extra month, then we have to take an extra month to get it right. This would be my comment on that. But I personally have a sense of urgency to move this forward, and I hope that y'all do too. My suggestion if we meet next, I'd like to call another meeting next Tuesday. We do not have the agenda set, but I think we'll, working with EBD, we'll set that that agenda for next Tuesday. If you have anything that you would like EBD or Millman to analyze in the meantime, by all means, get that to us. I would suggest that either Secretary Fetcher or Jake Lee, the administrator, be the focal point of any questions that we might have. And you know, I look forward to tackling this problem and getting it done, where we weigh the needs of the state and the needs of the employees, and that we have a good resolution when we finish this, our recommendation. Yes, sir, please.
So, my dad used to say, like eating an elephant, there's a lot of parts here. But really, there's not. There's about 6 parts, income parts and expense parts. I'm just a little concerned if each time we come to a meeting, all of that's on the table at the same time. It's really making it difficult for these guys because they've got tons and tons and tons of data. So if we can narrow this thing down and take a smaller bite, whether it be plan admin fees, whether it be retiree coverages, whether it be pharmacy, claims in general, or most of the claims or whatever, would that make it a little easier for you guys?
We've got it boiled down pretty well into the true levers. We can add the ones that you mentioned before, on the Medicare retirees, but this is fairly easy to use, and you can see the results immediately. It's like we can go in and change that 10% increase to a 5% increase, and you can immediately see it flow through the bottom line. So I think through the vetting process over the last 6 months, we've got it boiled down to, you know, what the key levers are, and if there are new ones, we can add them fairly.
I'll just add that we are looking at the expense side as well. It's just hard when we are in a contract right now to make those changes and then be effective by January 1, 2022. So long-term planning for 23, yes, completely agree. Looking at plan benefits and looking at expenses and all of those things you mentioned. It's just going to be hard to make a decision now and that go into effect on January 1, 22.
I think that's where I'm going with that, where I started the conversation. So we're gonna have meetings on a weekly basis, and we're gonna keep working around these same 8 or 9 initiatives. Because in order to create another initiative or lever, as you mentioned, we're gonna have to dig deeper into the fees, the claims, the contributions, the type of insurance program, or do we redo those 3, or do we change the out of pocket? Is that what we're meeting? I'm trying to figure out what we're meeting.
Well, I think our first objective is we have to set rates for January 1st, 22, because that's where all the other things go into motion, publicizing it, preparing for open enrollment. So I think that has to be objective 1. And then objective 2 would be that, looking at how we can create more levers for 23.
Keith, the thought I had,
I was just gonna say, I guess maybe the second lever, to me, seems to be, or the second objective seems to be that we set the rates for 22, get that information out, vitally important information for all parties involved. But then, to me, the second thing seems to be we need to address 2 deficits and the reserve and the refunding of 2 reserves for 22. Then we start looking at 23. I mean, just the way I see it, to me, the deficit and the lack of an adequate reserve are the next immediate obstacles.
Keith, one of the thought I had as I started, feeling this thing back is, this one is at a point where we don't have a tremendous amount of time. I don't know that we can get into the plans and a lot of the complex questions that pertain to these plans and make changes to them today or in this exercise that we're going through. I would suggest that we set up 22 based with the information we have and the recommendations we have from EBD, who have kind of gone through a lot of the things you talked about. And let's make a proposal to the legislature because of the urgency of 22 now, and then once we did make that recommendation, then we get into the sorts of things you're talking about, the intricacies of a plan and make recommendations at that point in time. My sense is we probably don't have enough time to really do that heavy lifting that you're talking about. If y'all don't agree with that, then I'll be here, we'll be here twice a week or whatever to get it done. This one has, the plans that we've recommended, that have been put on the table by EBD and by, Millman, they kind of weighed in a macro sense, with the employees taking some of the burden and the state taking some of the burden. And then the state may having, on the public school side, employees may have to be taking even more of the burden. But that is kind of weighing what what we need to do for now, but it doesn't get into the things that you talked about. You are pretty familiar with this business, so I obviously will listen to what you have to say, because you've got a lot of expertise and a lot of time invested in this in your profession.
I agree 100%. I think trying to go into that, and I was just wanting to clarify that when I brought it up the very first time, is I don't think that's a road we want to go down at this point, because I think it's way too much to farm.
I appreciate that.
When are your contracts, when do you normally sign your group of contracts? Is it July or calendar or what?
August.
You sign them so we sign this August, okay. Mr. Chairman, what I'm hearing is the core issues, and it is very frustrating to say, hey, set a rate. Don't do anything else, just set the rate. I totally get what you're saying here. But what I'm hearing is we need to set the rate, address the debt, and then address a policy, or what was the term you used?
Guiding principles.
Guiding principles, and then the future. And that's how I see the order of the four things we need to address now.
I do want to add for the board that our contract is through Blue Cross Blue Shield Health Advantage, and they have informed us that they plan to go up on our rates for the upcoming year. We do not know how much yet. We are in conversation with them about that, but we do not know how that will affect the plan either.
And there are some policy issues that we'll be discussing over this period of time too, that we will want to have discussions with the legislature, with regard to the policy of how we approach who pays and how, in what proportion, and what the state pays and what the employee pays.
And it's great that we're streaming, and hopefully some members of the legislature are watching.
I see a few are on. So is there?
I think you've got to have a motion, and we've got to, be real official about that, and setting meetings with Board of Finance, if I'm not mistaken.
Why don't, I would entertain a motion for us to meet again next Tuesday. And I would be, I'd also recommend either 9 or 9:30 as opposed to 10 o'clock, so we get moving a little faster or quicker. So if I could get a motion for that, we can do. I don't know that we need to set it. Again, I'll defer it to you all, whether we want to set it on for the next month or two, but we can do it one day at a time and come back each day, and each time we meet and make a recommendation for the next meeting. Y'all have a preference on that? I haven't talked to I haven't talked to EBD or anybody about that.
I agree. 9:30 works better for me.
Can I have that motion? Or say what, I'll make the motion. I'll make the motion that we meet next Tuesday, May the 18th, to continue our discussion, and we'll have an agenda out at the appropriate time.
Second that, Mr. Chairman, at 9:30.
At 9:30, that's correct. Any further discussion? If not, all those in favor say aye. All those opposed. Is there anything else to come before the board today? If not, I entertain a motion to adjourn. Move second. All those in favor say aye. Aye. Thank you.